Yo, what's up, everybody? It is Thursday, January 16th. Market was down today. We tried a couple of times to rally. We did have a tax drain yesterday, and I probably that continued today. Yesterday's drain was not that big. It was about 1.2 billion, which basically was nothing. I mean, we had like a 47, 48 billion tax drain, but that was mostly offset by a Social Security payment, an interest payment on Treasury securities, and a couple of other items. So it only ended up to be like a 1.2 billion drain. But I suspect that the tax deposits came in again today, so we had a weaker market. And I told you that this was going to happen weeks ago. I said January 15th we're going to have a tax drain, and I suspect that we'll see the negative effect run through the end of the month. February 15th, we get a quarterly interest payment, so that'll boost the leading flows, the fiscal flows, and that'll be the peak of this cycle, this quarterly cycle. Then we get into, April, May, going to be particularly negative this year. We got the usual April 15th tax drain, and then we have the May 1st, which is the tax drain. That was the IRS extension that was given to hurricane affected areas. So just be aware of that. So I'm giving you all these things in advance, and this, the other thing that happened today was a comment by a Fed official, Waller, who said, hey, we got to still think about a March rate cut, and bonds rallied and yields dropped. Now, I know for a lot of you out there, this was probably just a little coincidence, because I know you believe that it's the free market theory that sets bond yields. It has nothing to do with the Fed. It's the free market theory that sets bond yields. So I guess this was just kind of like some kind of strange coincidence that a Fed official said we got to, think about still having a rate cut in March, and the bonds went up and the yields came down. Just a weird coincidence, I guess, because I didn't see anything about the free market theory today, okay? Which I know a lot of you people believe in that. So that's about it, really. I mean, we're mid-month, which usually you see a dip in the leading flows. You get the big first of the month payments. You get the 4 Social Security payments weekly. And you get a little bit of a slowdown in the leading flows mid-month. Sentiment has turned negative, okay? If I look today at the AAII, that's the weekly American Association of Individual Investor Weekly Sentiment Survey, that was like the most bearish in, I think, 15 or 19 months. I forget offhand, but I sent out an email on that. And bullish sentiment was way down, like the same thing. It dropped. It's down around the lowest level in 15 or 18 months. The bull-bear spread, that was negative. And these numbers, hit readings that obviously we haven't seen in a while, 15, 19 months. But they're not super extreme, okay? Like the bearish sentiment is something like 30% above the historical average. Now, that might seem like a lot, but typically you get a market bottom in this thing when the bearish sentiment gets up like around 62% above the historical average. So it still has a way to fall. That's it. I mean, it's not, not much we could talk about. We'll wait. The thing is, we got to wait. Next week, Monday, Trump assumes office. This is when things are really going to start to get going. I've been saying this since the election. I said, we got to wait. We got to wait. We got to wait. Everybody has made their bet. Not everybody, but I mean, there's been a large contingent of investors who have made bets on a Trump presidency, saying there's nothing except inflation. Inflation as far as the eye can see. I've taken an opposite point of view, but I've said all along that we have to wait until he takes office. We have to see what the actual policies enacted, and then we could, we could have an understanding of what the impact of those policies are going to be. But there's a large position in the market right now that reflects a view that Trump's administration is going to be highly inflationary. And so if that thing unwinds, in other words, if that ends up not to be true, you're going to have one heck of an unwinding, which I think is going to manifest big time in the bond market. It could hit the dollar. By the way, I mentioned about the dollar where recently I took a small short position in the dollar against the yen. So I'm short dollar yen. That's working out pretty good. But, I've been looking, and I mentioned to you guys, I've been looking at U.S. net exports of petroleum. And that has, that's hit a resistance. I mean, we cannot get above 3 million barrels a day. And I think in order for the dollar to continue its rally from here, we need to see net exports boosted up above 3 million barrels a day. And now it's kind of coming off that level. It's been coming off that level in recent weeks. So I have a small short position in the dollar that's working out okay so far. So we'll see. But again, this is going to be a short video. We got to wait. Let's wait until Trump gets in. Let's see what he does by executive order. Let's see what the new Congress does in terms of any new fiscal policies. Tariffs, regulatory stuff, and we'll be able to flesh it all out and figure out what the impact is going to be. So anyway, that's it for today, folks. And please like and subscribe. Thank you very much if you've already done that. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Remember, I'm the only guy who has an applied approach to MMT. I take the concepts and understandings of MMT and I show you how to use that to invest and trade profitably in the markets, to have a better understanding of policy, of fiscal policy, of monetary policy, of trade policy. You're going to be more educated, and that makes you a more effective and efficient and profitable investor. I'll see you tomorrow. Bye.